Welcome everybody to the February IC update, coming to you at the end of the Victorian lockdown 3.0. We're celebrating release this afternoon here. Welcome Richard Dahl, Chair of the FMD Investment Committee, and Michael Reynolds, Director and Investment Committee member. Thanks again for joining me this afternoon.
Thanks, Lee.
Now, where I'd like to start today is where we left off last time, really, which was my hope that we would get a decisive result in the US. And we perhaps got both, but I think it was decisive. What's happened since then?
Well, Lee, I think the decision of the decisive election was divisive in America, particularly on the back of the Republican supporters obviously not getting their way. So we've seen an interesting development in terms of what the social ramifications of the election result is, but markets have clearly taken it in its stride. November was a spectacular month for investment markets, with a real turnaround in the optimism looking forward. That's flowed right through to the year, and equity markets have been up strongly. Central banks, both here domestically and offshore, have continued to provide really accommodative low interest rate environments, and equities have rallied as a consequence. January had a little bit of a hiccup, but we're now halfway through February, and markets are almost back to similar levels that we got to prior to the sell-off when the COVID-19 sort of pandemic sort of started to appear at middle of February last year.
Thanks, Mike. And Richard, through that period, what were the main activities or the decisions that the FMD IC made?
Yeah, so as Mike said, through November, a big rotation in the market. What does that mean? What does rotation mean? When we have our portfolio construction in the AMS funds, we'll have allocations to different types of investment managers. And there were some managers through the COVID downturn who really took advantage of buying stocks which were really out of favour. So we call these value managers. The managers in this situation were Allan Gray and L1 Capital, Australian shares managers. So they bought sectors like energy, retail to some extent, other sectors out of favour, which hadn't rallied until November. When the November US election result came through, the phenomenal rally in a lot of, including financial stocks as well, really rallied hard. And in the AMS funds, we saw those couple of managers, Allan Gray and L1 Capital, deliver returns of 20 to 30%. So what that meant is that, and the other managers as well had strong contributions. Australian shares managers were the strongest. International shares and our hedge managers did well. And we ended up in the AMS Balance Fund with a return of 7% for the quarter, 6% for the month of November, which is a really strong result, Lee.
Yeah, fantastic result, Richard. Not that we were able to deliver that every month, but it's a fantastic result considering the year that we had and where we ended the year is in a really strong position. So if we look ahead a bit, I think the key thing that we've been discussing today in preparation for this has been the low interest rate scenario that we're facing at the moment. Governor Philip Lowe made a speech recently, Mike, I think, where he indicated that Australian interest rates could be basically zero for 3 years or more. What does that mean? What do you think about that, and what does that mean for investors?
Well, it's certainly an environment of not free money, but as close as we'll probably ever see again. Domestic mortgage rates here for principal and interest loans are below 2%, which you probably need to go back to the 60s to those levels. What that's basically does is it's put an emphasis or a support to growth assets, and particularly the share market. I think if you look at sectors of equity markets around the world and also here, there are some sectors of the market that have really been significantly hit because of the COVID pandemic. So travel stocks, travel and leisure, hospitality, hotels, those sort of things are really out of favour and still have some challenges ahead, we think, for most of the year. But then there are a lot of other technology stocks, online shopping. A lot of those assets have still done extremely well. So the sectors of the market and the materials sector has obviously been extremely strong as well, particularly in the iron ore space here domestically. Australia's still a big beneficiary of the iron ore price. Vale in Brazil, who's probably the third largest iron ore producer in the world, not only had its dam disaster to deal with a couple of years ago, it's now also been affected by the pandemic, which has caused them difficulty in ramping up production. So Rio, Fortescue Metals and BHP have all been significant beneficiaries of that, and iron ore prices have remained unusually high, which has been great for our balance of payments here in this country. I think long term, what it reinforces is that interest rates are going to remain low. On a relative basis, investing, as we've said a number of times over the years, investing is a relative sum game between the opportunity set of fixed interest, property assets and equities and the various subcomponents of all those. And I think the investment committee is very clear in its view that relatively equities look the best of the opportunity set, and we've positioned our portfolio looking forward to take advantage of that in conjunction with the vaccination programs that are emerging and rolling out around the world.
Thanks, Mike. So, Richard, what sort of positioning is happening on the portfolios at the moment?
Yeah, we've embarked on a few changes which started off in pre-Christmas, have gone through January, and then we've got some others in train. And effectively what we looked at doing was to increase the hedging exposure against currency. The A dollar has been appreciating against the US dollar, and we believe that there's more to run. We've increased our exposure to emerging markets, an active manager in Fidelity. We have also introduced what we call a small to mid cap global manager in Fairlight, a new manager into the AMS funds recently. Take advantage of that growth. Those companies in the middle that have got good quality, strong earnings ahead. So those changes have largely gone through. Also, what we've done is Mike talked about sectors which have been still undervalued, and infrastructure was a real casualty, if you like, coming through the pandemic. And so our infrastructure fund, Lazard, which we've been invested in for many years for our clients, it's a good quality fund, but it's found with roads and airports and other assets in that portfolio have come back. What we've done is upweighted to that strategy to take advantage of an asset, a dislocation, if you like, Lee. So that's what's been trained. And then what we've done is going forward, what Mike was talking about, we've gone forward and looked at our alternatives in the portfolio. In a place like this where equities have an advantage, we are looking to exit out of the alternatives exposure and upweight our Australian and international shares.
Thanks, Richard. So in summary, there it's an increase. Well, not a major increase, but an increase towards the risk on and equities in Australia and mid to smalls in the US and globally. Yep.
Yes.
Yeah. And
I think Lee, just one additional point is so if you look at the world at the moment as in a broad spectrum, is equity markets look to be a little bit fully priced in some ways, and I think if you look at the S&P 500, we're going through reporting season in the US. About 80% of the companies that are reported thus far have all beaten their consensus earnings, and that's a positive outcome for the market, or supportive of where valuations have got to, and I think the investment committee's decision to do that has been on the basis that we think that the rollout of vaccinations around the world is starting to get some traction. Probably going to take longer than then everyone would like that to be the case. But I think if you look at the initial data out of places like Israel and the UK, it appears that the vaccination program is having its desired effect in terms of reducing the number of severe cases and illnesses. And so we are, by and large, optimistic about what that vaccination program looks like. And we think that will be supportive to investment markets as the year progresses.
Yeah, thanks, Mike. That's great. One of the things that I've been interested in is obviously the AMS funds have continued to generate income for our clients through the full cycle that we've been through in the last 12 months. But the continuing decline of term deposits, certain sectors of the community, not our clients perhaps, but others, may have in the past been relying on very low risk term deposits to generate income for to support their retirement. Now, if we look over recent years, we'll go back over the last 6 years, those term deposit rates have come down from around 4%, then down to 3%. So there's a 25% haircut on your income, down to 2% in the last couple of years or so, and then now basically nothing. Obviously, that's creating some activity in the Australian market where people are thinking, well, how do I replace that income? And leading to some pretty uncomfortable outcomes, I think, for some people. Mike, do you want to address that in terms of what people who aren't advised should be thinking about there?
Well, I think central banks have forced investors' hands to basically take more risk with their money. There are lots of new forms of investments, credit-related assets that are focused on income. But for those people that are non-advised, that is a bit of a minefield in trying to determine what the underlying assets that sits behind some of these offerings. Mortgage trusts are advertised regularly. Within FMD, we don't own any mortgage trusts for clients. It's just sort of not an asset that we've ever particularly liked, and probably still to this day, also don't have a strong liking for that sector. So when people make decisions, for those that are non-advised on their own, you are fraught with some increased danger of investing in assets that advertise a certain characteristic, but behind the scenes may be something that you're not quite sure what it really is. And I think what we spend a lot of time doing in conjunction with our research partners and Zenith and Caravel Consulting, it's an important part of identifying those things that we want to avoid as equally or even more so than what we want to invest in, because it's avoiding the traps that make people sleep comfortably at night.
And I think the message is always about diversification and being understanding what you're investing in at the same time, because some of these structures we've just talked about there, they might be okay for a fair amount of time, but it's when some sort of stress comes to the market in some way or form, and then we have things like defaults or lockups and things like that happen. If you've got quality assets, they'll bounce back, but if they're in distressed areas, they may not. And so it's about not going too heavily down a path you're not sure about, Lee.
Yeah, certainly, Rich. I think swapping a $100,000 term deposit for a $100,000 investment in one mortgage fund is a recipe for disaster.
Yeah,
the risk between those two is I don't know, broader than chalk and cheese.
Yeah, the federal government versus something.
Yeah, something maybe. Mike, I'd like to move on to one of your favourite topics, if I may, for a second, and that is short sellers. There was a bit of media about short sellers and things. Can you give us a bit of a wrap up of what happened there and what your thoughts are, what that might mean going forward?
Well, I think someone might be able to write a nice script for a movie at some point from what went on in late January. So look, for a simple explanation, short selling involves someone who thinks a stock is expensive. They wouldn't necessarily own the share, but they would then seek to go and borrow a parcel or a volume of shares in that stock, and they would pay a fee to the person that lends it to them. They would then short sell or sell those assets into the market on the basis that they think the price would then fall, with a medium-term view of trying to buy the same number of shares back at a lower price and then return the borrowing to the lender and pocket a margin out of that transaction. So sell high, buy back low, make some money. But when the difference, and this event's all occurred in America. So the difference between the US here and Australia is that we have much greater regulation around the amount of stock that is available for borrowing. It's what's called the free float in the market. And that's usually around 10 to maybe 15% of a certain number of shares in the market. And it's not all companies available on the ASX. And you require lenders, so companies like Australian Super and Vanguard and the big superannuation funds do have active stock lending programs. Incidentally, out of this whole event, Australian Super has recently cancelled their stock lending program indefinitely moving forward, which potentially may be a good thing for our market. But in America, is that it is a much more unregulated situation, and for example, the main company which was in question is a company called GameStop, which is a video games warehouse type thing, which had lots of stores around America, so fixed costs. And the short sellers in the market, which traditionally are professional hedge funds, had actually short sold more than 100% of the total value of the company. That couldn't happen here in Australia, but in America, the regulation allows that to occur by futures and options. And anyway, what eventuated was a group of social media vigilantes, if you'd like to call them, banding together and saw an opportunity. I suspect behind the scenes, there were some clever, smart, big investment groups also behind it, but they called their bluff, bought the stock back, pushed the share price up, and all of a sudden, all of those hedge funds that were collectively short had to scramble and to buy back their positions. The stock, I think, at one stage was down to $9 US and ended up at $500 a share. So you do the maths. The consequential loss of that leverage is massive, and that's why two significant hedge funds in the US needed to be bailed out. And so I think you might see some further regulation in that space looking forward. And the Democratic Party, who are now in charge, Senator Warren, has very much got that on her agenda.
Thanks, Mike. Interesting. I think EB Games are the Australian, which are in some supermarkets, and is the Australian subsidiary of that company. Yeah.
GameStop. Yes.
GameStop. Yeah. If we look ahead a bit for a moment, Richard, we talked a bit about the fact that we think markets are fully priced, but with the vaccine being successful in its rollout, that markets could continue to go ahead. Are there any other issues or risks that you're considering, that you and the IC are considering very carefully at the moment, that investors might need to consider?
I think the focus on economic recovery in the Northern Hemisphere and those sectors, we take flight between countries, international travel, infrastructure as well. I guess that will be all dependent on the success and rollout of the vaccine and the improving health outcomes for those Northern Hemisphere countries. And like Mike said before, if there's slowness in that and slowness in recovering those sectors, well, we'll see markets pull back from time to time.
Yeah. Are there any other things, Mike, that you think should be aware of or worth considering?
I think interest rates is something that we constantly keep an eye on. So longer dated government bonds here in Australia were back to sort of 1.35 to 1.35 to 1.4%. So that's quite a material sell-off from where they were. They traded down to 0.75, so it's almost doubled in price. That has a loss in terms of capital values in our portfolios. but we're happy to maintain that position, because while the share market continues to do well, if the bond market doesn't do so well and interest rates rise, well, that's a normal effect or normal expectation you would have. Your risk assets are doing well, your defensive assets tend to not do so well. I expect that we'll probably see some volatility return again sometime during the year. And normally what occurs is that interest rates will tend to rally, and that means that they will go from 1.4 back to maybe closer to 1%. And that's the cushioning effect of that strategy. So as we articulated before, we've reduced our alternatives position, increased our exposure to equities. We're happy to maintain our bond positions as the defensive part of our portfolio, but there's a trade-off between those two things.
And Lee, to another extent as well, and while we talk about vaccine rollout and everything, we're going to a new area. You think of the flu vaccine and the changes in that virus from year to year, and the updates in the vaccine. Scientists are saying, well, they don't know what the next year and the year after will be once we've rolled out the vaccine, mutations in the virus, etc. So I guess those things are unknowns, and the research scientists will be working heavily on that to work out, once we've got the vaccine rolled out, what does the future look like, that to make it sustainable.
Yeah. So there's still some uncertainty around all of that, and there'll be some ongoing disruption, as we've seen this week in Melbourne. It's going to continue to be a bit of a bumpy journey over the year, I think.
Absolutely.
Yes.
Well, gentlemen, they're all of my questions. Are there any final comments before we call this session to a close?
I think just a summary from my end, investment markets are, I think, at a tipping point in terms of how they perceive the rollout of the vaccination. We are confident that the vaccination program, although it'll be delayed longer than we think, we are positive that the data, I think, will come through, that it will have a positive effect and give us, we're going to have to live with it, but I think it will give us an opportunity to live a more normal life than what we have done for the last 12 months. And assuming that occurs, I think the outlook for investment markets is quite positive.
Thanks, Mike. Richard?
And Lee, I think the message which we've conveyed right through these recordings over the last nearly 12 months has been, while this pandemic has had terrible impacts through the world, health-wise and market gyrations, it's certainly been one that has given us the opportunity to look at market dislocations through the period and make some active changes through the active management service, and we continue to do so. So that's what the investment committee is doing. The number of changes we've made through that last 12 months has been more than what we'd normally make, and we'll be responsive as the vaccine rollout happens in the economic outlook that we're looking at, if that changes from time to time.
Great. Thank you, Richard. Thank you, Mike. Thanks very much for joining me today. I really appreciate your time. I look forward to joining with you again in 2 or 3 months and doing it all again. Have a great day. Thank you. Thanks for joining us, everyone. Bye.
Thanks, everyone.